Okay. So this is agency mortgage spreads. This is corporate spreads. Okay. Corporates, high yields are in blue, investment grade are in red. There's been a very huge dispersion since QE stopped right here. And since the bank stopped buying bonds, or banks started for selling in earlier March of this year. So banks were traditional large buyers of this asset class. They aren't buying anything. They're sitting and waiting and letting their paper pay off. And when you only have paper that's paying off at 5 or 6 CPR, that means you only get, call it 6 to 8% of your money back per year. 18 months ago, you were getting 40% of your payment of your bond back vis-a-vis prepayments every single year. So it's like private equity, real estate, venture capital. There's very little money flowing back into the system from paydowns. And most of the assets that have gone into fixed income this year have gone into money markets and T-bills. So I would expect us to see, I would expect spreads to tighten based on volatility. Okay. Volatility is coming down. This is the MOVE index. We're back to lows that we saw in February. Okay. Which was a fairly benign a market. Volatility is coming down. Spreads are still fairly elevated in MBS. Yields and risk adjusted returns are much better in MBS than it is in corporates and munis.